What's going on, YouTube? I'm here to tell you the truth about dividend investment. Now, if you're a dividend investor, great. If you're not a dividend investor, okay. But I'm going to tell you some myth about dividend investment and go over some dividends today to show you what the outcome if you do invest in a dividend.
Receiving a dividend work with a Roth IRA? Great questions from a 28-year-old. I'm impressed.
Well, a dividend-paying investment would be typically what's called a blue chip company, a large company. If they make a profit and they decide to distribute that profit to the owners, that's called a dividend. Dividends stay inside the Roth IRA until you're 59 and a half. It's tax-free like anything else.
And what the outcome be over the timeline. And we're going to use $500, but let's talk about some myth about dividend investment. Now, I'm a dividend investor now on a brokerage account, and yes, I understand the risk and taxation. So before you go in my comments and tell me, hey, dividend investment doesn't really grow. Hey, dividend investment don't do X, Y, Z. I understand the risk. And this is why I'm trying to have a conversation so everyone can understand some of the myth and some of the issue come with dividend investment. With the information ahead of them, I will go into a few dividend paying stocks that I believe you can get wealthy off of just by investing $500 a month from different age groups. So let's talk about dividend investments. It's a strategy where you purchase stocks that pay a portion of their profit to the shareholder. The truth is,
what's a DRIP account? Stands for Dividend Reinvestment Plan. But specifically, what is it? If you own stock and that stock pays a dividend, you can elect to have the dividends reinvest into buying more of those shares of that stock. This is a great strategy, especially if you don't need that income right now, but you hope to build wealth in the future. Many brokerages will allow you to elect to reinvest those dividends, and there are separate accounts altogether.
While dividends offer a passive income and stability, they're not free money, and they carry tax disadvantage.
Let's break down the key differences between qualified and non-qualified dividends. The main distinction comes down to how these dividends are taxed. So let me show you why this matters to your bottom line. Qualified dividends gets preferential tax treatment. So in 2024, most investors pay just 15% on these dividends. Some lower income investors might even qualify for a 0% rate, while high income individuals pay 20%. So non-qualified dividends, they're treated as ordinary income. So this means you could pay up to 37% if you're in the highest tax bracket. So let me put this in
limited growth potential and carry risk of being cut or suspended. For me, any investors, a total return approach, which include both dividend and capital gain, is more flexible and often more profitable strategy, especially before retirement. And that is what I do. I don't focus on dividend yield. I do a dividend growth and a capital gain so that I can take advantage of both. So that's what you need to understand. Make sure you like and subscribe to my videos, but let's get into what are some of the myths. So the number one myth you need to understand is dividend is free money. And here's the thing you need to understand. There's hidden costs of dividends.
So what actually happens to a stock's price after the dividend is paid? Here's the quick breakdown. On the ex-dividend date, the stock typically drops in price by roughly the same amount as the dividend being paid. Why? Because the value of that dividend is no longer attached to the stock. It's already been claimed by those who held it before that date. For example, if a company announces a dividend of 50 files and the stock was trading at 10 dirhams, you might see the price open closer to 950 on the X date. It's not always exact since other market forces like earnings, news, or sentiment also affect the price, but the drop is usually noticeable.
Dividends are not bonuses. So here's the thing. Dividends are not bonuses. When a company issues a dividend, its stock price typically drops by the same amount, and meaning the wealth simply moves from the company value to your pocket. That's the reality of it. And the other thing you need to understand, a taxable event. Dividends are considerable taxable income. Even if you reinvest them, this can create an unexpected tax burden, especially for retirees, and you have no control over the timing of this taxable event. In contrast, capital gain only taxes you when you sell your shares of stock. And the other thing you need to understand is reduce flexibility. Relying solely on dividend income leaves you less control over your cash flow. A total return strategy allows you to sell your share when you need the income, give you a little more flexibility and better tax efficiency. Yes, you have more control if you can sell your stocks, buy your stocks, but at the end of the day, those are some of the myths about the free money. Now, here's the other myth I want to tell you is lower growth potential. Reinvestment versus dividend. Companies pay out large dividends often have less cash to reinvest back in the business for innovation and growth. And this can lead to lower long-term returns compared to higher growth stocks and retain all their earnings. Yes, this is very true. They typically don't grow as much. And the other issue you have is opportunity cost. By focus on only dividend paying companies, you may miss out on the next big thing. You might miss out on other markets with higher growth potential. The historical total returns from dividend payout can lag behind broad market index over a long period of time. Yes, so those are some of the things you need to understand. Now, there's also other things like false sense of security. There's no guarantee, no the dividend trap, the inflation risk. Yes, you can run into that with the false insecurity with buying dividend, and you can also run into when dividend investment can make sense is for income in retirement. Reinvesting dividends if you don't need the income now, and the stability of a volatile market because dividend income is a better point in that because they don't fluctuate as much. So let's get into looking at some of these stocks so that you can get invest. Since we went over some of the issues, you now understand the issues about dividend paying stocks, and we're gonna just go and pick a. So we're gonna go into Vanguard International High Dividend Yield Fund. It's a pretty popular one with a 1-year return of 22.31%, a 3-year return of 41%, and a 5-year return of 47.23%, with a dividend yield of 3.91%. Now, we can look into the top holdings, and they hold HSBA, they hold NOVN, Shells, Royal Bank of Canada, Total Motor Corporation, but it's a dividend paying stock ETF. It's pretty safe. They're in non-US stock, 98.65%. Now, do I recommend you putting 100% of your portfolio in this? No. Do I recommend you putting some of your portfolio in this to diversify? Yes, I do recommend it. So let's talk about Vanguard High International Dividend. These are their holdings, and it's nothing special about them. Now, the fund seeks to track performance of benchmark of the index, and that's their whole goal. Now, their expense ratio is pretty low at 0.17%. So now we got the number, we got the idea what they have in their dividend. So now that we know that what the expense ratio is, what stocks that they have in their ETF, and how they've been performing, let's look at what happens if you invest $500 a month into it. So we're going to put it into this dividend reinvestment calculator. So let's say you're at age of 17 and you start doing this. The reason why I'm doing it at 17, I know it's unreasonable, but some kids start working and they can invest at 17. And if they invest it from age 17 till retirement age, how many years is that? I'll give you a second. It's 50 years. So 67, right? So we're going to put 50 years here. Let's see how much money you end up with and how much it's gonna be paying you. It says in 50 years you're gonna have 2 billion. I don't even think it's 2 billion. I think it's way more. Let's see. It says you can have over $2 billion or $200 million. Let's see. Hold up. 12 million, 87 million, 794 million. And in 30 years, you're supposed to have $153 million. Now, if you continue on, it's going to be this outrageous number. And let's be honest, that's not going to be realistic. It's going to be fluctuating. It's going to go up and down. So, realistically, if you wait 30 years, it says it's supposed to be $153 billion. Is it really going to be that? Who knows? But I'm just putting it in the calculator so you can see. Now, let's look at a more realistic number. Let's say from the age of 27. That is 40 years. Now, the number's still going to be outrageous. So, if you invest $500, you're going to have, for 40 years, supposedly, you're going to have over $2 billion. Is that going to be realistic? No. Most likely, it's not going to be that high. But if you end up with 100 million, are you going to be mad? So, let's go to 47. You got 20 years. Put it in the calculator. You do the drip. You're 47 years old. You got 20 years to retire. How much are you going to have? Now, this is going to be a more realistic number because it's closer and it's not that far out. So let's look at it. You're going to end up with $5 million. This is more realistic. So $5 million, and you're going to have a dividend payout or annual dividend of 5 million. No, hope you can have a total dividend in your annual dividend payout of $5 million. If it keeps up with this, is it realistic that it's going to keep up with this? No, but this is a number you are getting. So, will you take a risk? Let's say you don't like VYMI. And let's look at another stock that pays. It's FDVV. And yes, this is going to be a more realistic number. And they have a expense ratio of 0.15%. They have a dividend yield of 3%. And their holding is NVIDIA, Apple, Microsoft, AVGO, JPM Mortgage. So they have a pretty good mixed portfolio. So this is what I recommend. I have FDVV in my portfolio, but let's see what happens if you invest in FDVV. We're going to load the data. We're going to start at $0 initial investment. We're going to put $500. Let's say you're age of 57 and you want to retire with 67 and want to have a passive income. Let's see what you end up getting. Well, the ending balance is going to be $109,000 with a total dividend payout of $8,698. So this is a more realistic number what you might get from a dividend paying stock. Now, we're going to do from the age of 37. 37 is 30 years, right? 37 to 67 is 30 years. If you start investing $500 right now, at the age of 37, every month into this, and it keeps up what it says it's supposed to do, you're going to end up with $1 million and $171,000. And it's going to be paying you a total annual dividend. Let me see, end price, total dividend, 3.94 share dividend amount. dividend. It's going to pay you about $6,723 according to this annual dividend a year. And is it going to be realistic? This is pretty accurate what I think is going to happen. If the share price grows by 9%, and I'm not adjusting anything, this is just the data that's been pulled. Now, maybe you retire millionaire, maybe not, but this is what I recommend. Dividend investment is not for everyone, but if you have extra income, I recommend you trying dividend investment. So like and subscribe to my video, and that's all I got for you.